Assalamualaikum. Welcome to lecture 4 of ATX, which is Cessation of an Unincorporated Business. Earlier in my lecture 3, I have introduced you to when you are commencing an unincorporated business. This is the continuation of lecture 3, which is when you close down an unincorporated business, what are the tax impact. If you haven't watched my lecture 3, please do go watch my lecture 3 from my ATX playlist, where all my lectures are there from lecture 1 to 3. Because a lot of the things that you have studied in lecture 3, which is when you have commenced the unincorporated businesses, are applicable also when you are closing down the business. Okay, with of course few differences. So let's start. Here we are going to focus on a revision of basic business income tax. Next, capital allowances in the closing years. Capital allowances I've explained to you when you're opening the business. This is when you're closing down the business in the closing years. Then trading losses, capital gain tax, VAT, inheritance tax, incorporation new. See, this is incorporating. This is a new section, okay, in ATX. The rest all are from your taxation. Incorporation relief, this is new for the syllabus, and the summary. Now, out of this, we are focusing on income tax. We are still on income tax, right? This capital gain tax, VAT, inheritance will be explained to you later. But some portion, like when you're closing down the business, it will have an impact on VAT, it will have an impact on inheritance and capital gain tax. So the small portion of it will be covered here. Okay, the whole syllabus, capital gain tax itself is a whole topic that will be conducted after I finish the income tax. After I've completely finished the income tax, just the next tax, capital gain tax, and then inheritance, then corporation, and then VAT. Now, so here we are going to cover all these areas. If you're a self-employed individual, very important is your business income tax. One is capital allowance, the other one is trading losses. Now, there are other taxes like CGT, VAT, and inheritance, and incorporation. When you incorporate your company, when unincorporated becomes a company, you could be a partner or you could be a sole trader. Now you're turning into a company. You might close down your business and become a company. Okay, this section incorporation is only the new section in ATX. The rest all was covered in taxation. This is now just a revision. Okay, so now in this section there's a wide variety of questions. Why? Because unincorporated business can cease due to so many reasons. There are many ways they can cease. A sole trader might sell the business to another sole trader, or a sole trader gives the business, or a sole trader retires or dies, a partner leaves a partnership, a sole trader sells the business to a company. This is incorporation. Now, these are the main consideration. What are the income tax issues when you are seizing down? What are the loss reliefs? What are the VAT issues? What are the capital gain tax? Incorporation of a business. So all this will be covered in this lecture. And even for your ATX, this will be asked. Okay. So many of the concepts you have studied in taxation is very similar to ATX. But in ATX, you have to give advice. You have to look this exam from the advisory perspective. That's why you need the information of all this. That's why you need the knowledge of all this once again. Not that they will ask you, but you have to advise. If you close on what are the tax implications. Not only one tax. Remember, ATX is a question of multiple taxes interacting with each other. It's not just income tax. It is not just CGT. They will not ask you a standalone question like that in ATX. In taxation, yes, not in ATX. Okay. Now, when a business ceases, the key differences will be in the calculation of taxable trading profit. The taxable trading profit and how to calculate I have explained to you in lecture 3. So I'm not going to explain you here. Only the differences I will highlight to you. That is when you're calculating the capital allowance. This capital allowance for the final accounting period. Next, you are applying the closing year rules for the assessment of profit. When you are opening the business, there you are following the opening year rules. Here, closing year rules. And from your exam, okay, that is your exam from 1st of June 2024 to 31st March 2025. Good thing is closing year rules will not be tested. Okay, now we are coming to the second topic, that is capital allowance in the closing years. So now, remember, most of the time, the final period of account is not usually 12 months. It is mostly less than 12 months. Okay? So, but there is no need for any time apportionment as. You don't have to time apportion in the final period of account. Why? This is for capital allowance. Why? Because in your final period, you don't get your WDA, that is written down allowance, you don't get your first year allowance, you don't get your annual investment allowance. None of this you get in the final period, which you get when you're commencing the business. Okay, very important. Once again, let me tell you here, you need to start watching my lecture 3 before you come to my lecture 4. Otherwise, you might not understand what is this WDA, FYA, AIA. You must have studied it in tax, but in ATX I have explained once again from the basics. So please do go watch my lecture 3. Now, when you are adding anything, plant and machinery, so all additions are added, disposals, you'll be deducting it. Okay. If an owner takes over an asset, disposal process will be the market value. The disposals, that disposal will give rise to balancing allowance or balancing charge. Capital allowance computation is then closed off. Now, this is new. When you are trading between connected person, that means you are just transferring your business. So when you're transferring the business as a going concern to a connected person, an election is available in this condition. Remember, this is new in ATX, okay? That's why I have put it in bracket, it's new. New means new for ATX. It was not taught to you in taxation. So you need to pay more attention in the sections. You have a high chance of this coming in your exam. Once again, I repeat, when you're transferring the business, you're not closing down the business, you're not winding up, you're not liquidating. No. The business is still running, but now you're transferring it to a connected person as a going concern. That time you can make an election. You can make the election to transfer the assets at their tax written down value. Remember, at the end of the capital allowance table, the last balance is tax written down value carried forward, right? This balance now you can carry it forward. Okay, you can transfer the assets at their tax written down value instead of the market value. That means you can avoid the balancing allowance and balancing charge. Why? Because you're not making a sale. You're just transferring it to another owner, transferring it to a connected person. So now your tax written down value will be their tax written down value. Okay, that's why there is no balancing allowance or charge. Now, if the predecessor and the successor to a trade are connected, that means suppose me, I'm transferring my business to you. I am the predecessor, you are the successor, we both are connected. Maybe we both a family member or some kind of relative, and election can be made that time. What is it? The approach for capital allowance purpose is broadly to ignore the change of ownership. That means when you're calculating capital allowance, this change of ownership is ignored there. It is treated as if I am the one who is still calculating capital allowance. It's under me only. In fact, in reality, I have transferred it, but it will be treated in the same way. Whether I am calculating capital allowance or it's for use the same. When the transfer is to a connected person. So here, that means whatever I am transferring to you, the actual sale price is ignored. Actual sale price or transfer value is ignored. Next, plant and machinery is deemed to have been sold for the predecessor's opening written down value. My opening will be your closing. And no balancing allowance or charge will arise on me, on the predecessor, the one who is transferring. And no tax written down allowance are claimed in the period of transfer. When you're transferring, you can't claim WDA. The successor, that means you to whom I am transferring, use the same written down value to begin their computation. How do you begin your capital allowance? If you can recall my lecture 3, the capital allowance starts with tax written down value brought forward. So the successor uses the same written down value to begin their computation. But it is treated as a transfer and not an accusation. See, from your point of view, you are acquiring from me. It is not treated as accusation, it is treated as a transfer. And Successor claims the WDA on the tax written down value transfer. Now you claim the WDA, not me, because it is transferred to you. No AIA FY is available on this amount to the successor. First time when I purchase an asset, I can claim, right? AIA and FYA, but you can't do that. Once it is transferred to you, you can't claim it. Now, remember, to be entitled to this privilege treatment, there are some conditions. In taxation or ATX, any election that you could opt for has some conditions to it. Most of the time, taxation has some conditions. These conditions you need to remember. Number 1, election has to be made jointly by both the predecessor and the successor. It is not possible that I am making or not making. Both has to make together. What is the time period? Within 2 years of time, the succession took place. Election has to be made. Next, remember the dates, please. Whether it is within 4 years, 2 years, 1 year, 3 years, very important in ATX. Because when you are advising, date is very important. Okay? It helps you in tax planning. Now, both parties must be within the charged UK tax on the profits of the trade. Yes, it can't be, you can't make this election if one party is not charged UK tax. Maybe they are not residents in UK. Then you can't. Both parties has to be. Next, assets must be used in the trade immediately before and after the succession. Asset has to be used in the trade. If these conditions are not satisfied, you can't make the election. If no election is made, remember, this is an optional, okay? It is not compulsory that you have to make this election. If no election is made, assets are deemed to have been sold at market value as normal. And accordingly, balancing adjustment will arise on the predecessor. Success is treated as making an accusation. Now everything reverses, becomes opposite. Earlier, no balancing adjustment if you make the election. If you make the election, successor will not make an accusation. But if no election, it's just the opposite. This is how you learn. It's very easy to learn in this way. Just reverse everything. But, however, if the business is being transferred to a connected person, no AI or FY is available to the transfer. Remember, even if no election has been made and successor is having treated as an accusation, still no AI or FY could be claimed by you, by the successor. Now, this is how you see whether predecessor and successor are connected or not. They are connected if these 5 things are there. Number 1, they are related to one another. Like they are siblings of each other, they are ancestor or lineal descendant. Maybe a father or a son, a father or his father, I mean your grandfather and your your spouse. Next, one is a partner and other has the right to share in that partnership. You may be partners of each other. Third, one is a company and the other has a control over it. You might be having a control over a company, then you and the company are connected. They are both partnerships and another person has the right to share in them both. And they are both companies for one company and one partnership, and another person has control of them both. Okay? Either they could be both company, either one could be company, the other one could be partnership, and another person is having control in both of this. Right? Now, let's do a question. Test your understanding 1. So in test your understanding 1, Julia is transferring her business. Julia is a sole trader. She is transferring her business to a new company known as Jules Limited. Okay. Now, values of her plant and machinery has been given. This is main pool item for 1st April 2023 and 31st March 2024. 24,000 and 37,000. This is the market value. She has been selling at 31st March 2024. Remember the date when she's selling. So after incorporation, Julia will become a director and is the only employee of Jules Limited. Okay. Now, so you have been given the profit before the capital allowances. You have been given the tax adjusted trading profit for both the years. That is 82,550 and 85,000. Now Neither Julia nor Jules will receive any other income beside this trading profit. Now the question is, explain the options available with regard to capital allowance. You should consider the effect on both Julia and Jules, including supporting calculations, and advise on each alternative is best. See, advise on which alternative is best. There are many small requirements in this question. This is exactly the same way how you will be asked in ATX. First, you have to explain the options. In your mind, what are the options? There are two options. You need to visualize a mental picture on how you are going to tackle this question. Okay, two options. What are the two options? This is a transfer of assets to a connected person. One is with election. The other option is without election. Okay, two. Next, because this is regarding to capital allowance, this is when you're seizing down, when you're transferring assets to a company. Regarding capital allowance, what are the options? With election, without election. Now, you should show the effect to both. If you just show to one, you are going to lose half of the marks. Also with some calculations, some small calculations are required. Mostly it's your writing part. And you need to advise finally out of which of these two are the best, whether it's with election or without election. Okay, so now, very important is, this is a very simple question. Okay, so tell me, how are you going to start? First is option 1. Okay, let's go by option 1 first. What is option 1? Option 1 is when she's normally seizing the business. She hasn't made the election. Okay. There is no succession election. So it is without the election. Write the name of the option 1. Just don't write option 1 and 2. Examiner will not know what is option 1 and what is option 2. You need to label it clearly. So this is the normal cessation. Of business. Okay. One by one, you need to tackle each. Remember, one point you are going to write in one paragraph. This is how you answer. Okay. In 8 years. Now, what are the things you need to talk about? First, we'll put a list here, small bullet points. Then I'm going to write in the main table. This is just a margin. Don't do this in the exam. This is just to show you. First, because it's a normal cessation of a business, there will be a balancing adjustment which will arise. This will not happen if you have made the election. So talk about balancing adjustment in one paragraph. Next, WDA. Because you are closing down, you can claim WDA at 18% because it's in the main pool. Next, you have to now calculate that balancing charge. Calculate balancing charge or an allowance. In this case, it's a charge. And then you need to calculate. You need to do some calculation. And then we'll go to option 2. So now, since you know the points, first paragraph, I will write under this is about balancing adjustments. So because you are selling, a balancing adjustments will arise. Normally when you dispose an asset, balancing adjustments will arise. Okay, in the final sole trader capital allowance computation. How are you doing the adjustments? They are done calculated by reference to the market value. It's the same. Now you go by the market value. You refer to this. Okay. Now, remember, company can also claim 18%. This you are going to write in second paragraph. I'm not writing the whole sentences. Already answers are there. in your textbook under test understanding 1. So I'm not wasting time writing the whole answer, that you can read by yourself. My part is just explanation. Okay, second paragraph where they say company can claim 18% WDA. Okay, based on what? Based on the market value. Remember, AIA, no AIA. AIA will not be available in the final period. Why? Because these assets are acquired from a connected person. That's why no AIA. Now we are going to calculate this thing. 31st March 2024. What would be the balancing charge? Okay. So in your main pool, tax written down value. This is main pool. What is the balance? Remember, it is this 24,000 and you are selling at 37. Is the market value. You are disposing it at market value. This is without election. Okay, 24,000 minus 37,000. Disposal at market value. The normal situation. How much? 13,000. Your sell proceed is more. This is a charge, that's why it's in bracket in the allowance column. This is a small section of capital allowance. Okay. And now, next year, there will be an allowance available to company in 31st March 2025 also. Same. This is main pool, allowance. So you have acquired this at this value, market value, that is 37,000 on 31st March 2024. This is when you are calculating for the next year, 31st March 2025. So the market value you acquire, how much? 37,000. Now you can deduct WDA. Now you can deduct WDA at 18% in the next year, which is 6660. This is an allowance. You will write in the allowance column. So tax written down value carried forward. How much? 30, 3, 40, and this is 666. This is total allowance, TA. Now we'll go to option 2. Option 2, I'll write side. What is option 2? Succession election. So under this election, you have to talk about what? When you make the election, what happens? At what amount you acquire, that you have to write first. So when you are transferring it, okay, it is at tax written down value you are transferring, not at market value at the date of incorporation. Now you are writing why it is at this when you are making the succession election. Next para you have to explain the reason. Because the trade has been passed between the connected person. Trade passed between connected person. That's why. There's a trade that is happening and it is transferred between connected person. That's why is a tax written down value. Okay. What happens? Earlier balancing charge or allowance will come. Now there is no balancing charge. Okay, or no balancing adjustment. Just write adjustment. Don't write charge or allowance. No balancing adjustment will arise. Now, so company can still claim WDA 18%, but on tax written down value, not in the market value. Now I calculate the allowance once again. So tax written down value was 24,000. Okay, you can calculate 18% WDA of that, which is 4320. So this 4320 is the allowance. This is main pool. Okay. Now there are some things you need to remember when you make this election. Okay. Assets are deemed to be transferred at their tax written down value. Okay. And Julia can't claim any capital allowance because it's her final period of account. As a sole trader, she's ending, and now it is incorporated into a company. That's what we have learned, right? Final period, you can't claim capital allowance. Now, after this, recommendation. Remember, they have told to recommendation. You by yourself see, when you didn't make the election, there was a balancing charge of 13,000. That means you have to pay additional tax now. Already, if you see the situation of the company, of your profit are rising. So it is not advisable to not elect. And also next year you are going to have an allowance. This year, of course, you are going to have lower allowance, but at least it's better because you don't have a balancing charge when you are making the election. So now, first write the conclusion and then explain the points. Okay. Under recommendation, you are going to write the succession election will be beneficial to Julia as. Now you start giving bullet points. Why it is number 1, because if you see, you are going to save on the balancing charge of 13,000. You are going to save this with the election. Right? So if you make this election, you can avoid this. Because if you see the taxable total profit is increasing. So with that, balancing charge also will come, you have to pay more tax, which is not advisable. Next, how much tax, income tax you are going to save. This is balancing charge, income tax, IT. How much? If you see her income, taxable total profit, assuming there is no income, other income. Yeah, they have told there are no other income. So if you see it's 82,350, it's more than the basic rate band. It's in the basic and the higher rate band. So it is at 40%. Income tax would be at 40%. And NIC would be at 2%. So it's 42%. Together you are going to save. That would be the total saving. What is the balancing charge? Total saving. Now we'll do the total saving. Always work out the total saving. This is the balancing charge. On this, 42% tax you are going to save. That is 5460. But remember, this time you can claim less allowance. Earlier you could have claimed 66,660. Now you are going to claim 4,320. Allowance reduced. So how much allowance reduced? Always write however. This shows that you are going to write a disadvantage now. It's a correcting word. However, less capital allowance. We'll see what is the difference. 6660 minus 4,320. How much? 2,340. But even though that disadvantage is there, that decrease in capital allowance is very small compared to the amount that you are going to save. See here, total saving is this much, but you are going to lose only this much. Understand? And in terms of see, now you have incorporated. Always, whenever you are changing your status, so does your tax change. From individual to company, now you are going to have corporation tax. You are a company, you will pay corporation tax. At what rate? Check your profit is 82,550 and 85,000. It is more than 50,000. You have to know that lower limit and upper limit in company tax. We haven't covered company tax yet, but in taxation you have studied corporation tax, right? It is the percentage for is 25% corporation tax. Okay. So now, how much. How much of completion can be in this? See, the company would be able to claim this much less capital allowance, right? So 2, 3, 40 into 25%. In your book, they have written 26.5, but it's a wrong figure, it's 25%. $585. Okay, so now remember the total you have saved 5460. This much you are not going to save because you are paying less capital allowance. On that less capital allowance, you are paying the corporation tax. You are calculating how much will be the corporation tax. So this is the net saving. Net saving is the difference of this two. Okay, that is the net tax saving. So for this reason, it's beneficial for Julia to make the election. Remember the date when you can claim. Whenever election, you are going for election, date is very important. The last thing you have to write is date. So the succession election will need to be made by 31st March. We are selling 2024. Within 2 years of the disposal or when you are transferring, you have to make. That means the date when you are incorporating was 31st March 2024. You have to make the election within 2 years. That is 31st March 2026. Within 2 years of the date of incorporation. Structures and buildings allowance. Now, no balancing adjustment will arise on a building on which SBA has been claimed. So in the final period of account, SBS can be claimed until cessation. If this period is not 12 months long, then SBAs must be time apportioned. It's very clear. Okay. Now, if the business is sold, the vendor claims SBAs until the date of disposal. The purchaser can then claim this SBAs from this date. SBAs for the purchaser are based on the original cost to the vendor and the remainder of the original 1/3 year life. Okay, we'll definitely do question on this so that you understand the calculation part of this. It's very easy. Now moving on to next part of this lecture, that is trading losses. Very interesting one. And definitely in ATS you are going to get a question on losses. It could be trading loss, capital loss. Okay. You need to be prepared for all the options available. In third lecture, I went through this, but there I went through the loss relief options in the opening years. In this lecture, I'm going through the loss relief options in closing years. Very important. Okay, so most of the options I've covered in lecture 3. Now, coming back to lecture 4. The options available when you're closing your trade are same as those available to an ongoing business except with some addition. What is it? You can't carry forward. When you are an ongoing business, you can carry forward your losses. But when you're ceasing, you can't do that. Because there's no further trading profit that you can seize your trading loss against. Next, there is an extra option that is available when you're closing down. That is known as terminal loss relief. Next, additional option is there, that is incorporation relief when you are closing a business and starting a company. That is your incorporated. Now, so if an individual makes a trading loss in the closing years, what happens? You can decide to make a claim against total income and then whether you want to extend this claim against chargeable gains. And then if there is any remaining loss, you can claim terminal loss relief. So first against total income, then you can see whether you want against chargeable gain or not. If not, then terminal loss relief. So this is a small diagram so that you understand the relief in whole. Now, first, this is optional. Either you can relieve against total income, then another option is you can extend this to chargeable gain and then terminal loss relief. Okay. Terminal loss relief means you carry back against the trading profit. Only against the trading profit you can carry back. Next, incorporation relief you carry forward. So if you don't go through this option, one is if you don't go by the option, automatically it will be carried forward when you are incorporating only. If you are not incorporating, it will not be carried forward. So it is known as incorporation relief carry forward. Now, so this is just a summary of loss relief in closing years so that you understand. It's just like a summary. Going to be very helpful for your revision from the point of your exam. Okay, you can use this as a revision also before the exam. So terminal loss relief. Remember, this is an optional claim, but however will normally be claimed. Normally it is claimed. Why? Otherwise the benefit will be lost. Now you can set it against trading income. Okay, relief is to set the terminal loss against the trading income. That's why trading income is in bold. Not all income, trading income of the final tax year. If you have any trading income in the final tax year, first adjust against that, and then first against the final tax year if you have any, then only you carry back 3 tax years, only 3 tax years on a LIFO basis. LIFO means last in first out. Okay, so the most recent first and then you go back, keep on going back. So let's say 2024 you have made a loss. Okay, and the 3 tax years, previous 3 tax years will be 21, 22, 23. So when you're going back, first 23, then 22, then 21. That is known as LIFO basis. Terminal loss means loss of the last 12 months. This is the meaning of terminal loss. For 2023-24 loss, claim has to be made by 5th April 2028. That is within 4 years, right? 4 years of the tax year. This tax year ends on when? 5th April 2024. So 4 years from that, 5th April 2028. In short, almost all the reliefs are claimed within 4 years of the end of the tax year. Okay. Next is against total income. This claim is also optional. This you can set against total income. Okay, this is the loss in the final tax year that can be set against total income in final tax year or before tax year. This and or you have an option, either this year or previous year and this year. Any order you can come. And if it's an ongoing business, so this rule is same for an ongoing business also. This relief against total income is same for the ongoing business also. Now, 2023-24 loss. The claim must be made by 31st Jan 2026. For this year, it is 31st Jan 2026. 2 years. Because this rule is similar to an ongoing business. Next, extension against chargeable gain if you have it. Again optional, set against chargeable gain, final tax year or preceding tax year, same for ongoing, and by 31st Jan 2026. Now, calculation of terminal loss. How do you calculate? Very important that you know how to calculate. In your ATX exam, examiner has confirmed you will not be expected to calculate the amount of terminal loss. Good thing, you will not be asked. So don't worry about to know how to calculate because you will not be asked. A question could examine terminal loss relief, but if so, amount of the terminal loss they will give to you. You don't have to calculate. So it is not compulsory to make a claim against total income before claiming terminal loss relief. It is not compulsory, right? That you have to make against total income before you claim the terminal loss relief. However, where losses included in the terminal loss have already been relieved under another claim. Let's say there are loss under terminal loss that you have claimed through some other claim. Then what happens? Like maybe through total income or against chargeable gain. Then amount of the terminal loss must be reduced. Okay, let's do a question now. Test your understanding too. So here you have been given trading profit for 3 years with trading loss in 2023-24, which is 25,000. Now you have to calculate, this is a tax planning question. You have to claim your tax relief in such a way that it is most beneficial for you. Okay, so now let's do this. Always whenever you have a question where you have to relieve tax, loss relief, use Excel. Okay, make columns starting with the years 2021, 21, 22, 22, 23 and 23, 24. Okay, first is your trading income, then less loss relief, trading loss relief, TLR. I'm using the initials, and you have a property income for each year. So you have your trading profit 30, 25 and 10 with 5,000 of property income each year. Property income I'm writing separately because in some, like if you are going through relief against trading profit only, trading income, then it's better to keep property income separately. Don't combine the two and write. Always keep them separate because we don't know which option we are going to take, whether it is total income or just trading income. So I'm going to fill the table 30,000. Then 24,000, 10,000. Remember the year I'm making a loss, trading income will be 0, nil. Then property income 5,000. Remember, don't forget your personal allowance. Okay, you should claim your relief in such a way that you are not losing out on your personal allowance. Why? Because personal allowance you can't carry forward. Because loss relief you can always carry forward. It will not be wasted. Either you can carry back. In this option, because it's you are ceasing business, you can carry back. But personal allowance, one is wasted, is wasted. That's why you have to utilize personal allowance wherever you can. So if you see in the first case, okay, you can't relieve anything because there is no trading income in the current year. You only have property income, which is 5,000. So your personal allowance only up to 5,000 you can claim. The balance is lost. So here taxable income will be 0. Going back, it's a LIFO basis, like this, then like this, like this. Okay. So here we have 10,000. So up to 10,000 we'll claim. And you are left with just property income. Again, we are going to get the 5,000 personal allowance, which is 0. Remember, you could have claimed, see the total loss is 25,000, right? Out of 25,000, 5,000, you could have claimed 5,000 in this year and then just 10,000 here. 10 and then the balance from this year. But if you do that, you are going to lose out your personal allowance, you are going to waste and time. Okay. Current year, of course, you can't do this one because this year only against trading income. But when you're carrying back, you can relieve against total income. Rather than deducting just 10,000, you could have deducted 15,000. Right? But if you do 15,000, this 5,000 personal allowance will be wasted. So now you have relieved 10,000 here. Balance 15,000, because 25,000 is the total loss. You will relieve it from here, because your trading income is 24,000. So if you get, it is 14,000. Personal allowance is 12,570 for this year. So for this you can utilize personal allowance completely. Even here is 35,000. Nothing to relieve here. 12,570 and 22,430 is the taxable income. There is always an alternative, right? There is an alternative way to claim this relief. if you see here, I'm sorry, in the current year also you can claim against 5,000. I'm sorry, I've made a mistake. So out of that 25, okay, you could have claimed. But it's not beneficial because anyway this is claimed. This you are going to get a relief against personal allowance. It comes under personal allowance, less than personal allowance. So better to use personal allowance. Okay. You can even claim the relief even before claiming personal allowance also. Possible. But it is not beneficial. It will not be most beneficial. Because the total income is less than the personal allowance. So let personal allowance utilize. You utilize the personal allowance over the loss rate. Rules for relief on incorporation. This is new. Now, when an unincorporated business ceases, individual can seek to obtain relief from any loss as soon as possible. Individual will consider relief against total income and against chargeable gain first, then terminal loss relief next. Normally, if there is any unrelieved losses remaining even after those claims, the loss is lost. The loss is lost. You can't do anything with it. It will be unrelieved only after you have claimed against total income also, against chargeable gain also, against terminal loss also. Again, still some losses are there which has not been claimed. It is lost. However, when the business is ceasing due to incorporation, because you want to close down business and start a company, this unrelieved losses, you can get them relieved against future income that you are going to get from the company, which is beneficial for you. Now, so the loss relief in closing years, incorporation relief against future income from the company. Okay. So, if an unincorporated business is transferred to a company, wholly or mainly in exchange for shares, that means at least 80% of the consideration received from a business from the company is in form of shares. Now, you can carry forward the losses indefinitely. No time period is there, and provided the owner retains the shares throughout the whole tax year in which the loss relief is given. You have to retain the share, otherwise you will lose the loss relief. Provided company continues to carry on the trade of the former unincorporated business and losses are set against first available income that individual derives from the company. The first available income company gets, you can set your loss against that. It could be a salary, it could be an interest, it could be dividend. Then you can set off against type of income from the company in any order. You can set off against any type of income in any order. Most beneficial order would be first employment, then savings, then dividend, because of the tax rate. Because you are not going to get the starting nil rate band for non-savings, but you have savings nil rate band for savings and dividend, whereas for non-savings you don't have that. And losses cannot be set against future profit of the company. Note that the losses cannot be set against the future profit of the company. It is only against the first available income the individual derives from the company, not against the future profit of the company. Future profit of the company and first available income from the company are two different things. Remember, like salary, interest, dividend that you get from the company, that you can set your loss against, but not on your trading profit. That is a different thing. Now let's do a small question. Test your understanding 3. In test your understanding 3, you have, so it's about Bilal, who on 1st of Jan 2023 transferred his business to a company. Okay. Now, the trading loss is 83,000 is unrelieved even on 1st of Jan 2023. Now, from the company, he is going to get a salary of 20,000 per annum and pays himself a dividend of 10,000 in June each year. From his other UK companies, he is going to get income, that is a dividend of 3,000 per annum. Now you have to calculate the net income after relief for all the relevant years, showing how he will obtain the incorporation relief against future income from the company for the losses for his business. Remember, whenever you are given a trading loss question, there will be some income against which you can't claim your loss. Okay, that you can't touch. Same for this question also. So that's so now all this see the tax year. What is the starting tax year when you are changing it? From 1st of Jan 2023, it falls in the tax year 22-23, right? Now, we'll keep on claiming till we entirely get relief of this 83,000. There is no limit to the future. We'll see how many years we need it. Okay, 22, 23, 24. We'll just draw for 4 years and see how much we can release. If not, we'll keep on adding the column. 24, 25, 2025. There is no limit to this, remember. Incorporation relief. It's infinite. So now, first is employment income. Remember, they told 20,000 salary. Annual salary is 20,000. But he has started 1st of Jan. So from 1st of Jan to 5th April 2023. How many months? January, whole month, February, March. 3 months only he has worked. So he's going to get the salary for this tax year only for 3 months. That is 20,000 divided by 12 into 3, which is 5,000. After that year onwards, it's 12 months, so 20,000. So here it is salary 5,000, then it's 20,000, 20,000 and 20,000. Then we have less loss relief. We'll keep it for time being. Now dividend. We have dividend. Remember, this year there's no dividend. Dividend is once you start incorporating. Why? See, dividend, look at the payment date. It is paid in June each year. 10,000 will be paid in June each year. So 1st of June 2023 falls in the next tax year. It falls in this tax year. So 10,000, 10,000 and 10,000. Then we have dividends from other companies, other dividends. Remember, other dividend is the dividend which you can't touch. You can't claim your relief against this dividend. It has to be from the income of the company that you have transferred, which is 3,000. So it will fall here also. 3,000, 3,000, 3,000 and 3,000. Just write the dividend here. Loss relief. So let's start doing. You have to keep a memo to see how much you are actually relieving your loss. This is known as loss working or loss memo, you can say. What is the unrelieved loss? 83,000. So in incorporation relief, you start from 22, 23, 23, 24, 24, 25. And if you have any balance, 25, 26. If you need one more year, then let it be so. So here, first year, you can only claim 5,000 from your salary. Don't touch other dividend. So loss relief is 5,000. So here you will be left with a net income of 3,000. Remember, the question asked you to calculate net income. That is only your dividend from other UK company. So here it is 5,000. You still have some portion left. Next year, if you go salary 20, dividend 10, so up to 30,000 you can claim. You'll be left with 3,000 net income. So 30,000. Still 83 is not over. Even this year also 2010. So 30,000 you can claim. You'll be left with 3,000. Once again. This is 3,000. I'm sorry. I've written by mistake 30,000. So 30,000. Now if you see 30, 35, 65. So from 83, if you take 65, how much is left? 18,000. You need to relieve more. This is the balance, okay? Balance of the loss. It has to be 0. So this 18,000 will be relieved in the last tax year. So you have 20 of salary, 10 of dividend. That means 30. From 30, only 18,000. So if you are taking 18,000 out, you are left with 12,000. From 30, if you are taking 18, you are left with 12 plus this 3. So you are 15,000 net income. You see, everything is relieved. The next tax that the cessation of business is going to have an impact is on capital gain tax. Okay. So where a sole trader sells a business, or incorporates as a going concern, or sales of the assets to close the business down, all this represents a disposal for capital gain tax purpose, right? So a separate gain or a loss will be calculated for each chargeable asset of the business using market value as the proceed, where sales are either given or exchanged for shares in a company. Typical examples of chargeable assets. Okay. In case you forgot what is chargeable asset, since I have not started capital gains tax in ATX, is all those assets where CGT is taxed. It is known as chargeable asset. Goodwill. Okay. Provided the business is transferred as a going concern. When you're transferring a business as a going concern, there will be a goodwill also in it. This is a chargeable asset. Next, any land and buildings, investments. But CGT will not be applicable for cars, plant and machinery falling under less than 6,000. Okay. Falling under the 6,000 chattels exemption. When we go to CGT, I will explain you this once again, the CGT in depth. What is all this chattel exemption? What on which assets CGT is applicable, on which assets CGT is exempt from, will be explained once again. But for now, just shortly, knowing this is enough because we are under income tax. This is only when we are closing down the business, what is the impact on CGT? That is, that small section is only included. Any plant and machinery sold at a loss, there is no CGT on it. Because you can't claim, there is no capital loss if claimed capital allowance. Remember, if you claim capital allowance, there will be no capital loss. Reliefs are available. Rolled over relief, gift holdover relief, business asset disposal relief, EIS, SEIS reinvestment relief, and investors relief. All this relief will be explained when I explain CGT, capital gains tax. That's the next tax that I'm going to explain after I finish income tax. Next, reliefs available. If the business incorporates, incorporation relief is available. That means your gains will be reduced by capital loss first, annual exempt amount. So this annual exempt amount for this year, what it is, how much it is, we'll study when we go through capital gains tax. Once we finish capital gain tax, we can always come back to this lecture and see. Maybe that will help you to understand it better. Okay. Now, since it is capital gain tax, all the capital losses will be taken. Coming to the next type of tax is VAT. When you're closing down a business, it is going to have an impact on VAT also. How? You have to deregister. Then we are transferring as a business as a going concern. Next, inheritance tax. When you are selling the business at an arm's length price, there is no diminution in value of the owner's estate. That means there are no ICT, IHT implications. But if there is a loss in a value to the state, that means you are gifting the business or you are selling the business at undervalue, then there is an IHT consequences on it. Okay, for example, you are gifting to an individual. When you are gifting to an individual, it is potentially exempt transfer. Why potentially exempt transfer? This you have studied in tax, but in ATS I have not covered it yet. Why? Because inheritance tax is even after capital gain tax. So first in income tax I'm going to finish in ATX, then capital gain tax, then inheritance, then the other type of taxes. But briefly I will explain you. It is potentially exempt because for timing it is exempt. It might be completely exempt later on due to some event, or it might be taxable, chargeable later on. How? If the receiver to whom you are sending survives for 7 years, it is exempt. And if they die, it is taxable. Okay, becomes taxable. If they die within 7 years, taxable. If they die after 7 years, it is exempt. That's why potentially exempt. And if you are gifting to a trust, it is always chargeable. For lifetime, it is chargeable. This all you will explain in understanding inheritance tax. Okay, gift to a spouse is exempt. So if you are gifting a business to a spouse, it is exempt. If you are gifting that business to a trust, it is always chargeable. If you are gifting that business to an individual, provided they live or die within 7 years or not, it is potentially exempt transfer. That's why we have to know this definition. Because ATX is, what do I say? It's dependent on types of tax. All the type of taxes is going to have an impact. Okay, reliefs. Relief, there is one relief, that is business property relief, because this is a business. Now, when you're incorporating, you could be a sole trader or you could be a partnership. Remember, when you're a sole trader or a partnership, you are an unincorporated firm. When you decide to incorporate, means you're becoming a company now. So you can decide to incorporate. Because you felt that now it's better to do your trade through a company rather than through sole trader or a partnership. Okay, so here the partners can choose to set up a new company for the purpose or transfer the business to an existing company. You can set up a new company or you can transfer the business to an existing company. Once the company has been set up, then assets and trade of the business will be transferred from the personal ownership of the individual to the company. In most cases, you receive share in the company equal to the value of the assets transferred. Okay. Note that if it is a new company that is set up only with a few shareholders, let's say 5 or fewer shareholders, then it is known as a closed company. Closed company I have not covered yet. Closed company I will cover when I go through corporation tax, when I touch the company. Because for companies we pay corporation tax. So when I touch company, when I finish corporation tax, I'll be touching on the closed company. Closed company was not explained to you in taxation. It is a new topic in ATX. Now, so what are the tax implications when you are transferring a business to a limited company? So we are only focused on implications on the tax. Income tax, from the perspective of income tax. When you are incorporating, your business ceases at the date of incorporation. So for capital allowance, incorporation is treated as an open market disposal. However, as the trader and the company are connected, they can claim the succession claim. We have just done a question on it, where the assets are transferred at the tax written down value, open tax written down value, rather than the market value. Which method is chosen? Whichever the method is chosen will depend on the market value disposal, whether it will give a balancing allowance or a charge. If it gives a balancing charge, make the election. If it does not, don't make the election. And in either situation, whether you make the election or not, remember, no AI or FYI you can claim. Okay. Now, trader can also claim SBA until the date of the transfer. That means their trading profit in the final period will reduce. When you are ceasing, your trading profit in the final period will reduce. Why? because you claim SBA. Then company will claim this SBA from you. They will take over this SBA from you based on the original cost and the remainder of the original life. Any SBAs claimed will be added to the sale process when you're calculating a gain on transfer, unless incorporation relief applies. When an incorporation relief applies, there is no adjustment at incorporation. Instead, the total SBAs claimed by the trader and the company will be added to the sale process on the eventual disposal by the company. See, initially you don't do any adjustment when you are making the incorporation relief, but later on when the company is selling, okay, when there's a disposal by the company, that time SBAs will be added to the sale process. SBAs claimed by the trader and the company will then be added to the sale process. And if the business had unrelieved losses at the time of incorporation, you can get them relief against future income from the company. Next is NCI, National Insurance Contribution. As a sole trader, you are paying class 2 and class 4 NIC. Now, and also as a director or an employee of the company, individual have to pay employee class 1 NIC. You have to pay your employees class 1 NIC also. So, company also pays employers class 1 NIC in respect of the cash earnings paid to employees, and also class 1 NIC for the benefits that they provide. But remember, company cannot deduct employment allowance. I have finished national insurance contribution. NIC I have done. Okay. When we started the business. For the business, and when I finish my employment income, I have done NIC. Please go back to my lecture 2 and 3 to know NIC in detail. Which type of category of NIC do we pay for self-employed and employed? Now, company would not be able to deduct the employment allowance if the individual is the sole director of the company. Let's say you are the owner of the company and you are also the only employee. Let's say you are the director of that company. You can't claim employment allowance. You can't deduct that. Normally up to 3,000 annual employment allowance an employee could deduct, but only if they have more than one employee. But if you only have a sole director who is earning over 9,100, can't deduct. Next, capital gain tax. Assets of the business are treated as being sold to the company for their market value. There are two main ways in which relief can be given. Number one, incorporation relief or gift holdover relief. If you are gifting the business, rather than paying CGT now, you can hold over this relief. It's known as gift holdover relief. I will explain to you in detail when we go through this reliefs. Okay. Now I'm not going in depth. But you have to know that there are impact on these two places. That is the important thing. When we go there, then you'll be able to understand the picture better. VAT. If you are already registered for VAT, okay, so provided the company is registered for VAT, the transfer of the assets will be transfer of a going concern. That's why it is not a taxable supply. When you're transferring asset, it is no longer a taxable supply because it is a transfer of a going concern. As a going concern, you are transferring. So for the ease of administration, company can take over the trader's VAT registration also. Corporation tax. It is probable company will be a closed company. Very probability is high. When a business takes over, becomes a company, it's a closed company. Next, stamp duty land tax. This I finished. I've explained to you. Right? This is when there is a property involved. And this is payable by the company. Assuming the property is worth in excess of the SDLT threshold. This threshold was explained in lecture 3. So this charge you can avoid. How? By not transferring the property to the company. Right? You can avoid, but CGT incorporation relief would not then be available, as it requires all assets to be transferred. Remember, if you want to claim for incorporation relief, you have to transfer all your assets. If you don't do that, you can't claim that relief. But on the other hand, if you transfer everything, you have to pay SDLT tax also. right? There's a trade-off. So in this case, relevant assets could be gifted to the company, and then you can make a claim to defer the gain until the gift holdover relief provisions, under the gift holdover relief provisions. Next is inheritance. Should be no IST implications, as there is no gratuitous intent involved in an incorporation. So when you incorporate, no IST implications, but individual still owns the assets from the unincorporated business, but through a company now. So there should be no fall in value in the individual state. Remember, for IST to take place, there should be a decline in the individual state. If there is no decline, no IST. You are still having the same asset only, but this time you are having it through a company. Earlier it was through a sole trader. That's the only difference. Now, consideration should be given to the availability of BPR. What is BPR? Business property relief. This also I will explain to you in detail in the upcoming lectures. But this relief means your capital gain tax is reduced to 10%. Normally it is for commercial we have on rate, non-commercial we have a higher rate. Okay, but when it is BPR, it is 10% only. The CGT rate is 10%. So if it's an unincorporated trading business, it is usually eligible for 100% BPR because it's a business property only. You can't use it for residential purpose, no? So unincorporated trading business is usually eligible for 100% BPR. So that's why you have to consider whether BPR is available for this or not. However, going forward, the individual will now own shares. Okay, see, earlier they did not have shares. Now from unincorporated they became a company. Now they'll have shares. This might not be eligible for BPR, right? Those shares might not be eligible. Now, so this is the summary of all the type of tax. Income tax. What is the impact on capital allowance, trading loss? NIC, class 2, class 4 to class 1 NIC. Okay, there is a change from class 2 and class 4 to class 1 NIC. Earlier you were a sole trader, class 2 and class 4. Now once you become a company, you have to pay your employee also. So for the salary that you are paying to your employee, for the benefits you are paying to an employee, there's a class 1 NIC that you have to calculate, known as employees class 1 NIC. So that you have to now calculate. CGT, it is disposal at open market value. You can defer the gain under the gift holdover relief or this rolled over relief. Possible loss of business asset disposal relief on goodwill. VAT, transfer for going concern. SDLD, company is liable if property is transferred. If you don't transfer the property, company will not be liable. Then corporation tax, company will probably a closed company. And IST, no IST charge, but watch out for BPR availability in future. Now incorporation relief. Where an individual transfers an unincorporated business to a company, you get this relief. That means individual assets of the business are deemed to have been disposed of at the market value to the company. You can claim incorporation relief. That means any gain that is arising while you are transferring, you don't have to pay tax immediately. You can defer this until the shares in that new company are disposed of. When you're disposing the shares in that company finally, later disposal, that time you have to pay tax, CGT tax. Now it is claimed. Now it is deferred. You don't have to pay tax. How does this relief operate? Very important to know. How does incorporation relief? This is new for ATX. So your total net chargeable gain. If you are in line with your taxation, if you can recall your taxation, this will be a little easier for you. In case you have given your tax way earlier and now you are coming to ATX and you forgot, don't worry. Once again, when we go to our capital gains tax, you will understand all these terms. What is net chargeable gain? what is deemed disposal, and all those things. For time being, you might be little confused. Don't worry. I'm not going to explain in depth CGT here, but I will explain you in such a way that you understand how this really works. Okay? How we have taxable income in income tax. Same way, for when we are calculating CGT, it is known as total net chargeable gain. On this only we pay our CGT, capital gain tax. Okay? Same way how we pay on our taxable income, how we pay income tax, same way for capital gain tax. The only thing is you need to know how to calculate this total net chargeable gain. This I will explain you in CGT classes, in my CGT lecture. For timing, leave it. So just know that a total, okay, the total net chargeable gain that arises on deemed disposal. Of course, when you dispose only a gain will come, no? And you aggregate all the gains. So all the gains you are aggregating. Okay, then the total net chargeable gains are deferred against the deemed acquisition cost of the shares in the company. Of course, you are acquiring shares in the company. There are some cost to it. So that cost you will reduce against this gain. That's how it works. Reduce the gain against that acquisition cost of the shares because you're deferring it. That means deducted from the base cost of the shares. When we do questions, you will understand how it works. It's very easy. So now, BDAR, Business Asset Disposal Relief. This is on the subsequent disposal of shares. Okay, BDR on the subsequent disposal of shares is based on the qualifying condition. There are some conditions. If you are satisfied, eligible for 10% CGT, BADR. So when you're disposing of the shares finally, you might be eligible for BADR. Remember, the relief is automatic. This incorporation relief is automatic. You don't have to claim for it if you have met the certain conditions. Now, all of the following conditions has to be satisfied. Number one, unincorporated business is transferred as a going concern, not because you are liquidating or you are selling off, closing down. No. All of the assets of the business, other than cash, are now in the business, are now in the company. They are transferred to a company. Company could be new or existing, doesn't matter. The consideration that is received for the transfer of the business must be received wholly or partly in shares in the company, not in cash, in the form of shares in the company. All the conditions are satisfied, relief is automatic. How do you calculate incorporation relief? See, the amount of the total gain that arises on incorporation that can be deferred depends on whether the transfer is wholly for share or partly for share. It's possible you are partly giving shares, partly cash, or wholly shares or wholly cash. If you are transferring wholly for share, then the total net gain of the chargeable asset transferred to the company are deferred. The whole gain you can defer that you are transferring to the company. If it's partial, then only the partial gain you can defer. That is the only difference. Remember, no chargeable gain arises at the time of incorporation. When you are incorporating, there are no chargeable gain. It is only when you are selling off those individual assets, those chargeable assets that you are transferring to the company. That time, whatever gain you are having, aggregate them and defer it. So the base cost of the shares acquired will be equal to the market value of the unincorporated business less the deferred gains. This is the formula. If you are transferring partly for share, partly cash, partly loan, partly share, then incorporation relief will be equal to this. You can't defer the full gain, but only the portion which is there for shares. So total gain is equals to market value of share consideration divided by market value of total consideration. Only this much you can defer. That means this much only you can deduct against the acquisition cost of shares. So gain becomes chargeable at the time of incorporation. Total gain. Now, you cannot make a partial claim to defer only some of the gain. That you can't do. However, individual can choose to accept some cash or other non-cash consideration to ensure that incorporation relief. After incorporation relief also there will be some gain that would be covered by your capital loss and AEA, annual exempt amount. That means you are living after your incorporation relief, you are leaving your gain in such a way that you can utilize your capital loss also, you can utilize your AEA also against it. Understood? So that you can plan how much shares you are taking, how much cash you want. Now, it is known as tax planning. Disapplying. Incorporation relief you can disapply also. You can elect. That means you don't want incorporation relief to apply. This is useful in certain conditions. When you can see that before incorporation also, the gain that you are having is already covered by your capital loss in AEA. There's no use of making the incorporation relief. And it would be beneficial to take advantage of BADR at the time of transfer, which may not be available on the eventual disposal of shares. See, rather than deferring your gain, you don't know whether in the future you can take the advantage or not. Better to take the advantage of business asset disposal relief now when you're transferring. Because later on, when you are disposing your shares, you might not be eligible for that relief anymore. That means you have to pay higher CGT now later. So disapply incorporation relief to take the advantage of BADR now. You can't go for both the reliefs at once. That means you have to sacrifice one relief for the benefit of one relief. Okay, there's an opportunity cost. Election to disapply the incorporation relief takes place must be made by 31st Jan 2027. From the 2023-20. Remember, everything is from the tax year 2023-24 year onwards only, because this is your tax year, the time when you are giving your ATX exam. Okay. Now, if shares received are sold by the end of the tax year, following the tax year of incorporation, this deadline is brought forward by 1 year. That means bring back 1 year back to 31st Jan 2026. Remember, you are incorporating 2023-24. Next year, 24-25, you are selling their share. So then, the time to disapply the incorporation relief is another year after 31st Jan 2026. Otherwise, normally it is 31st Jan 2027. There is a 1 year difference. How do you interact with business asset disposal relief? BADR. In short, it is known as BADR, BADR. I call it BADR. So, if applicable, incorporation relief is given before considering this one. If the consideration is wholly for shares, there will be no gain. There will be no gain. If the transaction is wholly for share, no gain. And therefore, BADR is not considered. Remember, if there is no gain, you don't have to consider business asset disposal relief. If only there is a gain, only you have to consider BADR. Because if there is only gain, only you have to pay tax, no? And you want to reduce your capital gain tax. Otherwise, what's the purpose if there is no gain? If full relief is not available using incorporation relief, that means part of the consideration is in form of cash, then any remaining gain will usually qualify for BADR as it relates to the disposal of an unincorporated business. Remember, provided the business has been owned for at least 2 years before incorporation. Before incorporation, you have to own this business for at least 2 years. And remember, this BADR you can't claim for the goodwill. Any remaining gain with the possible exception of goodwill. Rest all will qualify for BADR. So chargeable gain after incorporation relief will be taxed at 10%. It's little bit too much to remember, but keep on practicing questions. Especially questions where you are in a position to decide which tax rate to use, you will understand. Try to work on questions where there are too many reliefs and you are confused which relief to apply first and which to go for. Try to do those questions, okay? Now, this is tax planning. So when you are disposing the shares, subsequent disposal of shares acquired at the time of incorporation. This is later on when you are disposing the shares also in the company. The later disposal, not the first one. First time you are transferring unincorporated to incorporation. Then you are transferring those shares also. That time, it would normally qualify for BADR. That means any gain that time that will arise will be taxed at either 0 or 10%. Why 0? Sometimes that time you might have capital loss and annual exempt amount, and maybe you don't have any gain left, so 0%. But remember, even that time you have to see whether conditions for BADR, BADR are satisfied or not. If it is not, you will not get the BADR. How do you know whether you are eligible or not? Two conditions. Individual has to own at least 5% of the shares. At least 5%. That means if it's more than 5%, condition satisfied. If it's less than 5%, condition not satisfied. That means you're not eligible for BADR. And they have to be an employee. And they have to be there for 2 years. 2-year qualifying period. Have to own the shares for 2 years, have to be an employee for those 2 years, at least have to have 5% of shares, then only BADR. Otherwise, no. They are very strict on this. Remember, the period of ownership of the unincorporated business prior to incorporation will count towards the 2-year qualifying period ownership of the shares. This is a good thing that they are giving you. Otherwise, they could have said that after incorporation will count the 2 years. No, they are saying while you were an unincorporated business, before you incorporated, even that will be counted in your 2-year qualifying ownership period of the shares. Where you are transferring your business is a going concern. Together with all the assets. That means you are transferring all your assets except cash. Either for shares, wholly for shares or partly for shares. Okay. However, if BADR is not likely to be available on the disposal of share, you can choose to disapply incorporation relief. Why? In order to crystallize a gain of incorporation so that BADR can be claimed now. Did you understand this? See, when you are incorporating, you must have got some gain. Okay? If you are thinking, okay, that you might not be able to satisfy the condition, the 2-year ownership, the 5%, or you're not an employee. If you're not able to satisfy the condition, those qualifying conditions to claim BADR later, disapply disapply the incorporation relief and claim BADR now. You understanding? So that you can crystallize. That means crystallize means any gain that you're having on incorporation, you are going to get a BADR now, rather than rather than claiming incorporation relief now, deferring those gain later on, and you are in a doubt whether later on you can claim BADR or not, business asset disposal relief or not. If it's risky to you, claim that BADR now and disapply your incorporation relief. Remember, one gain only, not both relief you can't claim. Note that gains in respect of goodwill may not qualify for BADR where the business is transferred to a closed company. What is this closed company? We'll understand later. Now let's do question. One small thing I would like to correct in my previous slide before I move on to the question, because the question which I'm going to do now are very much related to this. So in the earlier slide where I've explained your incorporation relief is fine, but gains that becomes chargeable at the time of incorporation, it is the market value of non-share consideration. Okay, that becomes chargeable. That means if you're having any cash, so market value of cash divided by market value of total consideration into the gain, that is chargeable. And incorporation relief is applicable on the market value of share consideration. Now let us quickly do the two questions relating to this incorporation relief, how it works. So the two questions are illustration 1, incorporation relief, and test your understanding 4. You need to calculate CGT payable by UN as a result of the above disposal. See, you might be thinking that we are too early on CGT. We have just finished income tax. Don't worry, because anyway, next we are almost finishing our income tax and moving to CGT only. And also, because incorporation relief is very much related to it's a capital gain. It's a capital transaction. Nature is a capital transaction where CGT is imposed once you become a company. That's why we need CGT also, because on CGT gain only we are going to get a relief, right? We are going to defer it. Okay, gift relief or a rolled over relief. All this relief comes in CGT, not income tax. So we are moving from income to CGT when the business is incorporated. So with the incorporation comes CGT, no more income tax. So CGT will be applicable. Okay, in a way it's good because it's introducing you slowly to CGT. We'll learn the tax rates, we'll understand how relief operates, right? In a way it's good. So let's start with illustration 1 first. As you can see, you have been given some assets and also the information about the taxpayer. Yoon is a taxpayer, he's a higher rate taxpayer. Why did they give you this? The reason they have given you is for you to decide your CGT tax based on your income tax rate. See, if you are a higher rate, if you are at an income tax rate, you will pay 40% for savings or non-savings. And if it is a CGT, if it's a non-residential 20%, non-resident residential 28%. For you to decide your tax rate, they will always give you in the exam whether he's a higher rate, or if they don't give you, at least they will give you the types of income. Your CGT is taxed after, see, your basic rate, higher rate, additional rate band are first utilized by your income. Then comes your capital gains. Then CGT rate will be applicable after you finish your income. If there's no other income, just the capital transaction, then first we'll utilize the basic rate band, then the higher rate. Okay, which is 10 and 20%. So the lower rate for CGT is 10%, higher rate is 20%. Unlike income tax, where we have 3 bands, here we only have 2 bands. So this is slowly I'm introducing you to CGT. I know it takes a little bit time to get over that income tax hangover, where we have 20, 40, 45%, and for dividends we have other rates. So for CGT is 10% and 20%. This is for non-residential. Okay, and 18 and 28. These are for residential. This is based on first you utilize your income tax. If you are a basic rate, they would have given you that you are a basic rate taxpayer, rate would have been 18%, 10%. Because you are a higher rate, whatever is not, you are not getting a relief, you are not getting a business asset disposal relief, will be charged at 20%. This is your deciding factor. Okay. Now, in CGT, you can always defer your gain. That means your gain will be taxed later on, not immediately. But income tax, you can't do that. You can't skip it. You can't skip that to someone else. Income tax, to the moment you get any form of income which is not exempt, you have to pay tax. This is the difference, major difference. And now, so we are coming to this one. Okay, on 15th of July. So they have bought a travel agency in Cornwall in August 20, paying 11,500 for the goodwill. Now, on 15th July 2023, they are going to sell a business as a going concern to Carriol. Okay, she took over all the assets except cash. See, she took over all the assets, means incorporation relief you can apply because all the assets has been taken over. That means incorporation relief you can, it is eligible. It is eligible for freehold premises, but these two are not eligible. State car and inventory receivable. Okay, because we don't pay CGT on them, it is exempt. And goodwill, yes, goodwill also will come there. Now, so in this para, they have given you the consideration. How much is the share? How much is the cash? Right? There is a cash also. 70,000 shares worth of this much. There is a share also. That means there is partly cash, partly share. That means entire gain will not be deferred, only partially. Now, 3% holding. Now, on this date, two things has happened. 10,000 ordinary shares has been sold to an unconnected person for 45%, and on the same day, 10,000 share has been gifted to her daughter. It's a little bit complex. So whenever you have so many things, so many transactions going on, this is the nature of ATX. Okay, you have to break down this one by one. You have to deal first with the sale, then with the transfer from business to company, then with the sale of the assets, then with the gift of the shares. This is how you have to work. There are 3 parts to this. Okay, so we'll see for this 3 parts any relief is eligible or not. If no, then CGT at 20%. Remember, anything qualifying for BADR, this you need to separate from assets which are gains which are not qualifying for BADR. Why? The rates are different. BADR are taxed at the 10% always. This again I will explain you how this works when I touch the capital gain tax in detail. Okay, but for now knowing this much is enough. Okay, so starting with gains not qualifying for BADR. Okay, and gains qualifying for BADR. There are two gains out of the three transactions. Two things will not qualify. We'll see why. Okay, but before deciding that, first we'll do the normal calculation. Don't immediately decide this will qualify, this will not qualify. We'll see the condition later. First we'll do the calculation. So this will leave. Okay, and then we have less annual exempt amount. See, remember, when annual exempt is there, better to always relieve it against gains not qualifying for BADR, because this will be anyway taxed at less 10%, but not qualifying they'll be taxed at more rate. So better to reduce your annual exempt amount from that one. Okay, for the current year, for this year, AEA is 3000 plus the 3000 brought forward from the previous year, so it's 6000 that you need to minus. So there are two columns, 6000. So 6000 just right here, keep it like that. Okay, and at the end you are going to have your taxable gain. We need to calculate the CGT, but right now we can't calculate. Now first we'll do the transfer of the business. We'll calculate the gain there. First we need a working number one, transfer of a business. This will qualify for BADR. So first is premises, proceed, cost. What is the proceed? 284 and the cost is 179, and goodwill is 44,000. There is no cost. There is, yes, there is 11,500. This is why you need to read each piece of information very carefully. Sometimes information might not be there in the same place. You need to find out in some other place. Okay, so it's 11,500. So 284,000 minus 179,000 is 105,000. Then goodwill, do this separately. You need to show like this separately. Okay, goodwill is 44,000, proceed. Cost is 11,500. It's 32,500. Remember, if anything is exempt, that also you need to write and show it is exempt. Don't leave it like that. So you have to say car / inventory and receivable. This is exempt. These are exempt assets in CGT. So it is 0. This 0 you have to write for that 1 mark. Otherwise you are going to lose away marks. Total gains before relief, 137,500. Now less incorporation relief, because you are incorporating now. How much is the incorporation relief based on this gain? 137,500, because there is a partially cash and share. Otherwise entire 137,500 gain you could have deferred. That would be your incorporation relief. So what is your total cash and sale. That thing you will get from here. You see, 70,000 share, value at 350 pence per share, and cash is 95,000. So if you do 70,000 into 3.5 pounds, it would be 245,000, and plus 95,000, the cash, the total consideration. Okay, so the total consideration is 340,000, 95,000 of cash and 245, and 245,000 is shares. Remember what you can defer: only the portion of the share, not the cash. Only the portion of the share consideration only you can take as an incorporation relief. So which is 99,081. You can round this to whole number also, it's up to you. 38,419. This is the gains which will qualify for BADR. 38,419. So 38,419. Okay, I will go here and write it. Gains qualifying for BADR. 38,419. One part is over. Remember, incorporation relief is given automatically. You don't claim. Okay, and one thing you might be thinking, that why we have given this thing, goodwill, gains qualifying for goodwill. Why did we give business asset disposal relief for that also? You see here, even for this together, okay, this is added with the premises, and on this you are given the business asset disposal relief. You might be thinking why? Because if you see, it is 3% only, less than 5%, no? And it's a closed company because you don't have many employees there. Okay, remember, even if it is a closed company, okay, any gain relating to goodwill will still qualify for business asset disposal relief. Why? Because Yoon's shareholding is less than 5%. It is less than 5%. If it's less than 5%, and for goodwill, this rule is there when we study business asset disposal relief regarding goodwill. This I haven't touched yet. I'll be explaining it to you in the CGT classes. But there it is said that the relief, I mean for goodwill, any gain for goodwill, even if you have less than 5%, you are still eligible for business asset disposal relief. It is qualified. It is there. The rule is there. That's why. So you don't have to worry. If it was more than 5%, you can't claim for goodwill. Goodwill will not be claimable because it's less than 5%. That's why. Now, 2. When you are selling this 10,000 to an unconnected person for 45,000. Now we are calculating gain on this. Here, you can claim business asset disposal relief. Now for this gift. Those two are not eligible for BADR. This is sale. Properly write which type of transaction. There are 3. Sale of 10,000 shares. So what is the sale proceed? 45,000. They've given you. And shares acquired. Remember the shares they have acquired was 70,000 for 35 pence. 350 pence, so 3.5 pounds. Which is 245. Sorry, I'll write inside 245,000. This is the shares they have acquired when they have unincorporated. Less incorporation relief. Here you are going to deduct that incorporation relief. Because they are selling the shares now. But only 10,000 shares, not the entire shares. How much? This incorporation relief you will take from your working one. This one. 99081. This is the relief. Not this one. This is the gain eligible for BADR. Please don't confuse the two. So it is 99081. 145,919. Remember the deemed cost of sale of 10,000 shares. What is the deemed cost of 10,000 shares? This you have to work out. How? Take this 145,191 45,919 multiply by how many you are selling? 10,000. How many did you purchase? 70,000. That means out of the 70, 10,000 if you are selling, what is the cost? You have to take the proportion. So 2846. This 125,073. This is this amount. This amount is the deemed base cost of remaining shares. That means after you are selling, from what you have purchased, what is remaining? This would be your deemed base cost of the remaining shares. Some shares we are having there. And this you deduct from your sale proceed, 45,000, which is 24,154. This is what we need. This is your chargeable gain. This is not eligible for BADR. This will go here in that table, main table. Gains not qualifying for BADR. Sale of the shares. Even the gift of shares will not qualify. We'll see later why. 24,154. Working 3. Gift of 10,000 shares. Okay. Remember one thing. Why this is not eligible for BADR, sale of shares. If you check the ownership, Yoon's combined ownership, that means when he was in the business and when he was having the shares of the company was 2 years. Why 2 years? If you see, he was in the business in August 2020. Incorporated 2023, after 3 years, more than 2 years. So ownership is counted. If you count the ownership, combined ownership is more than 2 years. But if you see, Yoon owns less than 5%, only owns 3% of the shares in the company. That's why BADR is not available. If Yoon must have worked for the company and owned at least 5%, then this would be qualified for business asset disposal relief. Coming to the gift. Gift anyway, gift of 10,000 shares to the daughter is not eligible for BADR. That's not a condition. Okay. Now, capital gain. Capital gain for 10,000 shares previous we have calculated. So it will be same here, 24,154. Now the gift holdover relief. It's a gift. So you are eligible for gift holdover relief. The entire amount, 24,154. That means there is no gain, zero gain. Why? Remember, this is a gift of an unquoted. It's given in the case study, unquoted trading company. It's an outright gift of qualifying shares for gift holdover relief. That means this is a qualifying share. The entire amount you can take under gift holdover relief. You don't have to restrict it. Okay. So it is zero. When we go through gift holdover relief or gift relief, you will understand the condition. So this is zero. Okay. So now take the total. 38,419. The total is 24,154. Deduct 6,000. Annual exempt amount from here. 38,419. 18,154. Now we'll do it in the tax, capital gain tax, CGT. First qualifying, 38,419. Always start with the gains which are eligible for business asset disposal relief. That is at 10%. 3,842. Then 18,154. Remember, he's a high rate taxpayer, so 20%, and this is not residential. Otherwise, they will mention 7,473. This is the total CGT. Now we are moving to
Our test understanding 4. Test understanding 4, Sanvi sold her business to a limited company for 1.1 million. Okay, all the assets were transferred. That means incorporation relief you can claim. Freehold premises, market value is given, cost is given. Goodwill, only market value is given, no cost is given. Inventory receivable, they are not eligible, they don't come in the picture. So imagine in the first one, 100,000 ordinary shares. That means 100% shares. In the second one, partly shares, partly cash. 80,000 shares and 220 in cash. You have to calculate the gain immediately chargeable and based cost of these shares. And then state the tax planning advice that you want to give to Sanvi. That is part B. Okay. This type of question will be there for your ATX. So let's start. If you go, I'll do it here itself. 700 minus 240 is 460. Okay. Goodwill, there is nothing. 250 minus 0. So 250 for goodwill. So if you calculate, it is 710,000 is the gain before incorporation relief. Remember, in the first one, it is 100% shares. So entire gain you can defer. That means incorporation relief. So incorporation AR will be 710,000. The amount of the gain only will be your incorporation relief. The entire amount. That means there is no tax. Chargeable gain is 0. What is the base cost of share? Because requirement told you to calculate. If requirement does not tell you to calculate, don't calculate. They have sold it for 1.1 million. How much did incorporation relief is 710,000. So 390,000. We are assuming that business asset disposal relief is delayed because we are claiming incorporation relief. Okay, when we subsequently dispose the shareholding, that time we'll see whether BADR will be eligible or not, whether we satisfy the conditions for BADR or not. But they have not mentioned anything about selling off the shares later on. That's why we are not working whether we are eligible for BADR or not. Because we want to calculate the gain immediately chargeable. Right? This is the question when we are transferring. Next. Partly cash, partly share. So first one is over. Now we are in the second one. Same. Gain will be same. 710,000. But the relief, the incorporation relief will be minimized now. How? See, the cash is 220. So out of 1.1 million, if it is cash is 220, shares will be 880,000. The balance shares and cash is 220. So up to 880 shares, the proportion of share only you can take as incorporation relief. So gain is 710,000 into 880. This is shares into 1.1 million because the total consideration is 1.1 million. So if you take from 710,000, you can deduct, this is incorporation relief, okay? This is the working. 568,000. 142,000. This is gain, chargeable gain. This, okay? So earlier we had 0, so no use of going for BADR. Here, this will qualify for BADR currently. What would be the base cost of share? What is the value of the share? 80,000. Deduct the incorporation relief, 568,000. $312,000. This is the base cost. Okay. This is eligible for BADR, but this is delayed. Now, tax advice. Part B. What is the tax advice you would give for Samvi? Remember, you have to look for other information, whether they have other capital gains or not, or anything like that. Okay, if there is nothing like that, then you have to write by assuming. Okay, always assume the no. There is no other gains, there are no other income, there are no other anything relating to VAT or corporation tax or anything like that. Always assume the no part. Okay, don't assume yes there would be any other gain. Don't go by that. So assuming Sanvi has no other capital gain in the year, Sanvi should consider accepting non-cash consideration. That means cash. She should accept cash so that it would give rise to a chargeable gain, chargeable gain, which is equal to your annual exempt amount, assuming no capital loss. Okay, you have to accept cash, which would give you a charge. See, if you accept cash, you will have a chargeable gain. That chargeable gain, make sure it is equal to annual exempt amount, which is 6,000. Up to 6,000 of chargeable gain you can accept. That means accept cash, because if it is shares, entire amount is exempt. I mean deferred. So gain that you require is 6,000. Now you are working backwards. How much should be your cash? You're trying to find out that now. So the deferred gain, we'll work out the deferred gain. What is the gain currently? 710,000. For you to have the gain, you can defer up to 704,000. From 710 we are working backwards. Now what should be the market value of the share? Remember, this should be your deferred gain. So market value of shares, this is how we work out. We are working multiply by 710. 710 was your gain into total consideration. We want to find this variable. Make this the subject and find out. So market value of shares would be 1090704. So cash is equal to 1090, okay, 1 million, 1.1 million total consideration, right? This is market value of share. So just deduct this. The balance is your cash. This is 9296. This much should be your cash for you to have a gain of 6,000 and get it also exempt, and that means no CGT. Okay, there is another way you can find this out. That is, find the cash, divide by market value of business. That means total consideration, total C, into net gain. Total net gain is your annual exempt amount, because you don't have any capital loss. So cash divide by 1.1 million, net gain is 710,000, gain is 6,000. So cash would be 9296. Same way. This is an alternative calculation. Any one you can present in your answer, whichever you find easier. Try to prove. You don't have to prove in your exam, but this is for your understanding, whether you are right or not. See whether it is correct or not. So capital gain before relief is how much? 710,000. How much you are deferring? 710,000 into what is your cash? 1090704. This much you can defer, which is 4,000. 6,000. You see, this is your gain. This is what you wanted. So if you have this gain, your AEA, annual exempt amount, is also 6,000. 3,000 of current year, 3,000 from brought forward, and 0. This is your taxable gain. So now we are moving on to the last part of this lecture before we do some questions and summarize the whole lecture. Now, there is an alternative deferral using the gift holdover relief provision. We have done a question on this just recently. Now, one of the disadvantages of incorporation relief is that all of the assets has to be transferred to the company except cash. Otherwise, incorporation relief is not eligible. So, it is very common for the trader to retain the land and buildings. Why? They want to retain this land and buildings rather than transferring, because they want to avoid stamp duty, land tax. and gives the trader the ability to extract funds from the company by renting the premises to the company. Although this would restrict any business asset disposal relief on a subsequent sale of the premise. Later, when you sell the premises, you are going to be restricted on your business asset disposal relief. So if you are going for an advantage on one side, there's a disadvantage on the other side. This you need to remember. Next, if the trader wishes to retain any assets other than cash, incorporation relief is denied, and any gain then will be crystallized on incorporation. That means there will be a gain that needs to be taxed on. The CTT tax will be there. So as an alternative to an incorporation relief, you might go for a gift holdover relief, where you can defer your gain against the base cost of the assets of the company. That's how we have done for the 10,000 shares that we have gifted to the daughter of you. Now, as a first step, any non-chargeable asset like inventory, receivable, they should be transferred to the company in exchange for shares. Okay, better to transfer the non-chargeable asset like inventory, receivable should be transferred to the company in exchange for shares. There will be no gain on these assets, and the cost of the shares will be the market value of these assets. Then goodwill and any chargeable assets are then gifted to the company. So you transfer the non-chargeable asset like inventory and receivable, because anyway there is no tax on that. Then what you do is gift the chargeable assets, better to gift to the company, like chargeable assets. Any chargeable assets or goodwill, better to gift to the company. Then any gain, if you are giving it as a gift, then any gains that arise, you can defer, known as gift holdover relief, right? There's a disadvantage though. See, every relief has some advantage and disadvantage, okay? Disadvantage is, yes, if you are giving a gift holdover relief, it lowers your base cost for the asset. It gives the company lower base cost for the asset. Why? Because you are deducting that deferred gain against your cost of the asset. So you are going to have the lower base cost for the asset. Yes. Then if incorporation relief were used, if you are using an incorporation relief, you might be having a higher base cost for the asset, right? So if you're having a lower base cost, what happens? Later on, even if currently you are deferring, later on, there will be higher gain, which will lead to higher profit or gain or profit arising in the company on the future disposal of this asset. Can you understand the picture now? If you are later selling this asset in the future, that time your gain will be higher, because that deferred gain you are deducting against the cost. That means your base cost of the asset is now deducting. It's now lower. So that lower cost, when you are deducting against your sale proceed, you are having a higher gain, because smaller amount if you deduct against the sale proceed, now you are having a higher gain. So currently you are deferring, later on you are having a higher gain. Now it is just your timing. See, eventually the taxpayer are very smart. They're actually they are taking the tax out of you. The only thing is you are just delaying the timing. Whether today or tomorrow, they will catch you on that tax that you have not paid right now. They're just giving you that flexibility to defer. This, in a way, is good, because it's helping you in a tax planning. I mean, cash flow forecast. It will help you in your to manage your cash flow. Maybe you are short of cash now. You might not be able to pay the tax. No problem. Defer it and pay it in the future. So this will help you in your cash planning also. Working capital management. So in a way, it's good. This is for tax planning and also for managing other aspect of your business. But eventually, you're not gaining anything. Maybe yes, you are deferring the timing. You are delaying the timing, but you are going to pay the tax. Okay. Now, the shares still have a very low. See, the shares still have a fairly low base cost. So there'll be a larger gain on the mutual disposal of the shares. Same for the shares also. Same for the assets, same for the share. The base cost will be lower, therefore the gain will be higher. Now, let us go through just the incorporation relief summary. This is not the whole lecture summary. Whole lecture summary I will finish after I finish the 3 questions after this. So incorporation relief, we started with gains arising on the disposal of individual assets. These are relief available. Gains not charged at the date of incorporation. That means when you are incorporating, no gains are chargeable. Then you are deducting that gain from the base cost of the share. Then there are conditions. Number one, business has to be transferred as a going concern. All of the assets has to be transferred except cash, and consideration could be partly or wholly for shares. Automatic relief, but you can disapply by 31st Jan 2027 for incorporation made in 23-24 tax year. Okay. Remember, for disapplying the incorporation relief, you have to make the election. That is not automatic. You have to disapply this relief. There is a election for it. But for applying, there is no election. It is automatic. Then consideration has to be given for wholly shares and partly share. If it's wholly share, it's very easy. Total gain is equal to your incorporation relief. That total incorporation relief will be deferred against base cost of the share. No gain at the time of incorporation. Gain are deferred until the subsequent disposal of the assets of the share. When it is partly share, incorporation relief is restricted to this value of the share divided by total consideration into total gain. We have done a question on this. Chargeable at incorporation, that is value of non-cash, that means value of share consideration divided by total into total gain. Consider the business asset disposal relief also on any gain still subject to charge. Whether after this, you can manipulate the cash consideration. How? You can try to get a gain equal to amount of your annual exempt amount plus your capital loss. And there is an alternative claim. What is it? You can claim for gift holdover relief with, of course, some disadvantages are there. So now let us do 3 questions before we summarize this whole lecture. Test your understanding 5. So in test your understanding 5, you have to explain how the gift holdover relief can be used to shelter the gain on goodwill and calculate the base cost of the share. 2 requirements are here. So this is about La transferring his business to a company. All the assets are transferred with the exception of freehold premises. Now, so you have the question here is explain. Okay, focus on the verb, very important. And you need to calculate. You don't have to calculate the gift holdover relief. Do you? You definitely have to. Even if the word says explain, yes, you have to explain. That is the ultimate requirement. But because you have to calculate the base cost of share, for this you have to calculate gift holdover relief too. You need this for the base cost. Otherwise, you can't calculate the base cost of share. Understanding? So sometimes a requirement might not be so visible. It might be hidden inside another requirement, like calculate gift holdover relief, like that. So now what I've done is I have already the answers are there in front of you rather than me writing the answer. The reason is because this saves a lot of time, right? So okay, so first we'll eliminate the ones which are not chargeable to capital gain tax. Okay, so inventory and receivables. So first we'll talk about this 100,000. They are not eligible for it. That's what they are told. Okay, so they're exempt from tax. Because they're exempt from tax, so even if you give them a gift and try to hold over, it's of no worth because they're anyway exempt. So rather than, because they're exempt, you can transfer them. Okay, this can be transferred to the company in return for shares rather than gifting them, because anyway they're exempt assets. Even if you give them as a gift, it is of no valuable. If you give a chargeable asset as a gift, yes, you can defer the gain. But inventory and receivable, better to transfer them to the company in return for shares. So now, what is the value? 100,000. So the shares take on a base cost equal to the market value of these assets. You have to find the base cost of the shares. So for inventory and receivable, because this is the market value, this also will be taken as a base cost of the share. That's what is there in the second paragraph. Okay. Third. So we'll talk one by one. Now we'll talk about goodwill. Okay. I'm just telling you how the structure of the answer came. So goodwill. Okay. If you see goodwill, you can gift because this is eligible. This will be taxed. So this you can give to the company and the gain is 300,000. Already they have given you the gain. But remember, incorporation relief is not available. Why? La did not transfer all of the assets with the exception of freehold. If you transfer all the assets only, you can incorporation relief will be available to you. Otherwise, it's not available. So now this 300,000 gain can be reduced to nil. Can be reduced to nil if a gift holdover relief claim is made. If you are making a gift holdover relief, why? Because the entire 3,000 you can defer. If you are taking everything by using shares, no cash, consideration is share, entire gain could be deferred. So the entire 3,000 could be deferred. So if this is deferred, so from the market value of your share, if you deduct the 3,000, there is a nil. So the base cost will be nil for the goodwill. Okay. You can defer the gain and the company will now have a base cost of nil for the goodwill. You understanding? Because they have a cost of market value of 300,000. So from 300,000, you deduct the gain of 300,000 that you have deferred, base cost will be nil. Okay, it's very simple and very easy. Now let us go to test understanding 6. Here it is more like a theory. Okay, consider the alternative courses of action to transfer of the business and explain any immediate and future taxation, including advantages and disadvantages. So this is about Isaac, who has owned a trading business for 3 years. Now they want to transfer the business to Plum Limited. In exchange for 500 shares, there are 50,000 shares in issue. Out of that, only 500 shares they are exchanging. So how many? How much? What is the percentage? It's very important to work out the percentage if you are not given the holding. It's 1%, just 1%. Okay, Isaac will be an employee of the company after the transfer. Fair enough. Now, the gains are given for goodwill 50,000, freehold 80,000. Okay, the gains before the relief. And now it is billed in 2016. There's a reason why they have given to you. We'll see later. So it is anticipated that the property will increase in value by 50% in the next 2 years, at which time it is likely to be sold and larger premises will then be rented. You see, later you have to pay more tax because value is increasing by 50%. So now how are you going to start this? You see, there are a lot of points which is given here. So we'll go one by one. First one, because this is about considering alternative. Okay. So now, as Isaac is transferring whole business, gains will automatically be deferred. Because whole business is transferred, so all the gains will be deferred. Okay. That is under incorporation relief. You have to explain now. Okay. Automatically deferred against share consideration only. Share condition that you have received, against that you will defer. That means against that you will deduct this gain. Remember, you have to talk about current and future. So on future disposal of share, what happens, that also you have to explain in answer, because immediate and future tax consequences. So on the future disposal of the share, what would be the CGT base cost? The market value of the share at incorporation minus the gain now deferred. This you have to write. Even if it is understood, you have to write it. Okay. Now, so we'll talk about BAD. Most of the time when you're transferring the business, try to talk about this relief, BADR. You have to say whether it's available or not. You have to talk on its availability. That you have to check based on the condition. So in this case, it is not available. We'll see why. When you're disposing the shares in the future, you're not getting this relief. Why? As I told you, Isaac is not owning 5%. Isaac only owns 1%. Just now we have calculated it. 500 divided by 50,000, right? If Isaac owns greater than 50%, is an employee of the limited company, and that means all the conditions has to be satisfied, and satisfy the 2-year ownership period, then only BADR could be claimed. But because Isaac only owns 1% based on this one criteria, even if he has hold it for 2 years, even if he was an employee, but he does not hold 5%, greater than 5%, only 1%. Therefore, this will not qualify. This is how you need to write your answer in ATX. Because this one condition is not satisfied. If it's an and condition, if it's an or condition, he would have got BADR easily, because he is an employee and he's owning for more than 2 years. Now, coming back. When we are not qualified for something, we have to talk about the tax CGT rate. Don't forget to talk about the income tax rate or CGT rate. When you are not qualified for something, then what would be the rate? If you are qualified, then what would be the rate? This you have to explain in the answer. So because he's not entitled, then any gain could be taxed at 10 or 20%. Leave it as 10 or 20. Don't write at 10 definitely and 20. You can't say, you don't have any evidence to say that. It will be based on what? Depending on ISEC's basic rate band remaining. We don't know how much income he has. But provided in the exam they say he's a higher rate taxpayer. If this question was higher rate taxpayer, then what? Or an additional rate taxpayer, then what? Then definitely is 20% only. Then don't write 10 or 20%. But because the case study is silent here, see, they have not mentioned anything about his income. Now you know whether he has other gains other than this or not. You don't know. That's why write it in a probability, this or that. Okay. Next, talk about disapplying in a incorporation relief. You need to talk about this, whether there are chances of this as well or not. So you can consider disapplying this. What happens when you disapply? Effect. You have to talk about the effect. What was the gain? Freehold property 80,000. What was the gain related to goodwill? 50,000. So this 80,000 will qualify for this one at 10% if incorporation relief is not there. What about the goodwill 50,000 gain? Will it qualify for this one? Yes, this also will qualify for this one. Why? See, although the goodwill is transferred to close company, how do you know close company? He is an employee in that company. Because ISEC owns less than 5% of the share. If ISEC owns more than 5%, goodwill will not be, you cannot claim BADR, bad R for goodwill. This is the condition. When we go through that, go through capital gain tax, this condition you will understand better. Okay. I'm sorry. Total CGT payable is given here under a working. We'll see that working later. First, we'll finish the points. Okay. Now, remember to disapply the incorporation election must be made. This have to be there in your answer. These are keywords. Okay. Next. What is next? Next, we'll talk about consideration. Okay. Next is consideration. Next term is, so this whole para is on consideration. This is on disadvantage. This is how you understand. Right? So you can consider the mix of cash and share. You can take some share and some cash so that you can utilize the capital loss and AEA. Okay. If you are taking mix, remember the ones where you have a cash consideration, that part will be chargeable immediately. That you can't defer, only the share portion. Now coming to the disadvantage. Remember, if you are going by incorporation relief, there's a long-term disadvantage. What is it? You have transferred the property to the company, no? So the property is transferred to the company. If this is done, remember the property is appreciating in value by 50%. Right? So when you are selling that, there's a double taxation. Why? First, there will be a corporation tax on company because now it is under the company when you're selling the property. Number two, when you're extracting the profit, there's a further income tax charge on that individual. You see? Next, we have some more. Just two more points and then we are over. Because working part, if you see, is very easy, very simple. Not much is required, but writing part, this is the difficult part in ATX, writing. To think about the points, okay? Now, what if he keeps the property, he retains the property? What is the effect? This also is the next point. So if he keeps the property rather than transferring, what happens? Then any subsequent disposal will not qualify for this one. Why? Because to qualify, you have to transfer everything, the entire business, all the assets. Okay. Next. So in addition, what happens? Incorporation relief will not be available. You can't get this gain to defer the gain on goodwill also. As ISEC is not transferring all business assets to the company. Even the incorporation relief that you're getting on goodwill also, you will lose it if you retain the property. Okay. However, Incorporation relief might not be there, but business asset disposal relief would be available on that gain. Why? The transfer is following the cessation of the trade. Because that transfer is because when you're seizing the trade. So when this happens, you can claim BADR. That is for goodwill. But incorporation relief will not be there for goodwill. So this gain could be taxed at 10 or 20%. Next. Alternative. See, one more relief that you are missing out. All this we have discussed is gift holdover relief. So rather than gifting the goodwill, okay, you can claim, okay. An alternative would be, see, an alternative would be to give the goodwill and then claim this gift holdover relief. Remember, to claim a relief, you have to have that transaction first. For example, to claim the gift holdover relief, you have to make a gift first. Otherwise, you can't claim. So you first have to give the goodwill and then you claim gift holdover relief on that so that you can defer the gain on goodwill. Okay. And so enabling the retention of the property outside the company. That means try to retain the property and try to give the goodwill. In this way, you can save more tax. Okay. But remember, company cannot claim relief for the cost of the goodwill for corporation tax purpose. You can't claim. Yes, for capital gain tax, you can claim. Income tax, yes, but not for corporation tax. This you will understand when I explain corporation tax in detail. Okay, which is after CGT and inheritance. So it's a long way to go. Anyway, coming to the chargeable gain. So there are two gains: freehold building and goodwill. Both qualifies for this one. Remember, for incorporation relief, you might not gain, but it qualifies for this. Less this one, AEA 6,000. Then this is the taxable gain. Taxable gain, because it's BADR, you are taking 10%. So this is your CGT. Understanding? You are not getting the incorporation relief because you didn't transfer the building, but BADR, business asset disposal relief, you will get because it's a business asset. Anyway, so coming to test understanding 7, the last question for this lecture. Okay, this is a long question. In fact, there are 3 parts to it: part A, part B, 2 parts, part C. First, part A. Calculate adjusted profit after capital allowance. For this, you need to calculate capital allowance. Profit is already given to you. Part B. Calculate capital gain tax payable on the sale of the business. Second, explain the capital gain tax and inheritance tax implications. In your ATX, you will often be asked to do this. Multi-tax scenarios will be given to you where 2-3 taxes are having an impact on one single event. Like this. This question has an impact on CGT point also, inheritance tax. That's why you have to know all the taxes very well. If Marwa were to give the business to her son instead. And third requirement, C, calculate CGT payable, assuming all available reliefs are applied. Okay. So first we'll finish. For part A and B, you can use this information, and for part C, the following one. Okay. So already you have been given the profit for the 9 month before capital allowance. Okay, she's seizing, and the tax written down value. This is for capital allowance. They have given you the brought forward balance from main pool and car. Private is 40%. They have given you. Next, all the assets in the pool was sold for 13,255, and the car is 13,000. Now you have been given regarding the sale of the business, the value of office, cost of office, value of goodwill. Okay, so first we'll calculate the capital allowance. So first we'll quickly go to this one. So this is that table of capital allowance where we used to have special rate pool, main pool, all the other pools. Okay, so only tax written down value brought forward is given in the question. Even the disposal value is given in the question. Just deduct. If you see, this is a balancing charge in the car because sale proceed is more than value. Here it's a balancing allowance, so you write this in the allowance column. This is a balancing charge. Disposal is more. 13,000 is more than 12,700. Balancing charge means you have to pay tax. That's why it's in bracket. 300. So just take 60% because this is the business use you have to take. Private use 40 means business use is 60. So 180. So if you deduct, this is the total allowance. Okay. This total allowance you have to deduct from the profit already given to you. But this is very simple. Okay. Part A. Remember, what about SBA? Structure Business Allowance. As the business was completed before this date, this will not be, they will, no SBAs would be available to be claimed. That's why you need to know the days very well, when you can claim and when you can't. This will be asked in your ATX. That means any business completed after 29 October 2018 only you can claim SBA. Okay. Now coming to part B. To calculate capital gain tax. Okay. Already you have been given the proceed and the cost of the office, and goodwill only the proceed. So if you add both this, you are going to get the gain. From gain, deduct annual allowance 6,000, taxable gain you get. And this you will charge at 10%. Why? It is qualifying. Always write qualifying or not qualifying for BADR. Because everything you have, see, when you're selling the business, everything you have disposed. That's why you are getting BADR. Okay. Now, you also have to check whether BADR is available for goodwill also or not. Not all the time it is available for goodwill. Okay. See here the cost of this one. Now, just wait a minute. I want to just take the percentage. Okay. So here, BADR is available on the gain relating to goodwill as the business is not being transferred to a closed company, of which Marva is 5% shareholder. Okay, that's why this is available. So always assume a business is not being transferred to a closed company if they don't give you a specific information. Otherwise, they will give you the specific information if it's a closed company by saying he's an employee and things like that. And also they will give you the percentage. And also, if SIB had been claimed on the building, this would be added to the sale proceed and increase the gain on transfer. This is just for your understanding. Okay? You don't have to write this in your answer. Coming to second part, implications on CGT and inheritance. First we'll finish CGT, then inheritance. Okay. Asset would be deemed to be sold at market value. Gain would arise. Remember, when there's a gift, both Marva and the son jointly has to claim this gift holdover relief to defer the gain. This is a rule. And the gain would then be deducted from the cost of the asset for Marva's son, giving him a bigger gain in the future. That means when you're eventually selling it, the son is trying to sell the asset, he's going to have a bigger gain. Coming to inheritance tax. Remember, this is a gift to an individual. Okay, if you can recall your inheritance from taxation, I have not covered in ATX yet. I have yet to cover, but if you can recall from your taxation, any gift to individual is a pet, potentially exempt transfer. If the donor dies within the 7-year only, it will be taxable, chargeable. If the donor survives the 7 year after the gift, it is forever exempt. Okay, that's why it is known as pet. So any gift to an individual from the inheritance tax point of view, it is pet. So this is a gift of the business, it's a pet. First thing you have to identify whether it is chargeable, pet or exempt. Completely exempt in inheritance. Number 2, which IST would be payable? There will be no IST payable during lifetime, no IST. But yes, if the gift only becomes chargeable if Marva dies within the 7 years. Because this is 100% BPR is available, there is no IST to pay. Why? Because he's giving the whole business. She owns it for more than 2 years. Therefore, 100% BPR is available, leaving no IST to pay. But remember, if Marva's son sold that business before Marva's death, BPR will be withdrawn. There are conditions when BPR are withdrawn. This I've explained in inheritance tax. Okay, coming to part C. Part C will go through the information. So here you have been given the 400,000 breakdown of the offer of all the assets, office, plant, car, net current assets and goodwill. This is 150 in cash, 250 in shares, total 400,000. 1% interest. Okay, Jumbo PLC. Calculate CG payable. Okay. So here, first, before explaining this, first we'll calculate. What is the gain? Gain is this much. As above, total gains before relief. Already we have calculated the gains here. You see here, this one, 335. Okay. Why? Because only goodwill and this will come. This will not come. So part B is related to part C. Whenever you are given part A, B, C like that, you have to use always, you have to be dependent on your previous parts. Okay. So it is this, and on this amount, what is the value of the cash? A share 250 out of total. This much will be deferred. And also AEA, so this is taxable and this will be at 10% because this qualifies for this one. So this is your CGT payable. Okay, that is done. Now, so when you're transferring of business to Jumbo, assets would be deemed to be sold for their market value. Gains would arise on the chargeable asset as before. Because you are transferring the business to a company as a going concern in exchange partly for share, incorporation relief automatically applies. But because you have cash also, only proportion of it you can defer. So a proportion of the gain before this one would be deferred until the shares were sold. So that's it. So let's summarize this lecture. When you're seizing an unincorporated business, number one, you have to think from the point of business income tax and other issues. Capital allowance, you are going to have a balancing allowance or balancing charge, except SBA, that is structure business allowance. And when you're making a succession election, that happens when you're transferring to a connected person. So you transfer a tax written down value rather than sale proceed. Then, if it's a trading loss, there are reliefs. Terminal loss relief, that means loss in the last 12 months of trade. You can carry back 3 years on a LIFO basis and against trading profit. Relief against total income. Current or previous tax year, maximum restriction applies. And incorporation relief. Carry forward against income from company if you are incorporating, then only. Other issues are VAT, you deregister, transfer of going concern, and incorporation. Income tax cease. See, the moment you become a company, that means you incorporate, you have to pay corporation tax, no longer income tax. And also your NIC. You stop paying class 2 and class 4 NIC because you are no longer a sole trader. Okay, you get CG2 reliefs because you are making capital disposal now. And also stamp duty land tax. VAT, transfer of going concern. So all this comes into the picture. So that's it for this lecture, and thank you for watching, and I shall see you in my next lecture. Don't forget to subscribe to my channel if you haven't subscribed yet. Thank you.